Hello everybody. Still vacationing, but I thought I would follow up on my previous webcast where I talked about demographics and the implications for monetary policy from the perspective of the developments in the natural interest rate. I will talk about the same topic today, but from a slightly different perspective, from the perspective of the implication of demographics of money demand and how that impacts monetary policy. So a good example of this is Japan since the early 80s, a phenomenon that has continued since the early 80s, the aging of the Japanese population. What is happening in terms of money demand when we grow older? Well, when we're young, when we're in our 20s, when we're in our 30s, we're willing to take quite a few risks in terms of our investments. We will tend to be happy to be long equities. We don't hold so much cash. We actually would tend to take on some debt. As we grow older, we will switch our portfolio from risky assets. We'll sell our equities or disinvest our equities, and we'll buy treasury bonds. We will hold more cash. We don't want to be in a situation where we're going to retire in a few years and then we lose all of our money. So the older we get, the more cash we hold and the more safe assets we hold. In terms of money demand, that of course means that as the population of a country ages, there would be a tendency for that population to hold more cash. Money demand goes up. The flip side of that is, of course, the money velocity is going down. If we look at Japan, this is exactly what happened through the 80s. As the Japanese population was aging, money demand was going up and money velocity was going down. In fact, there was a very clear relationship between, on the one hand, the share of the population in the working age in Japan and the development in money velocity since the early 80s. In the 80s, the working age population, a share of the total population, was declining in Japan, as was money velocity. In the 90s, both of these were more or less flat. However, from beginning of the 80s, beginning of the 2000s, we started to see the working age population decline once again, and in line with that, we saw a renewed drop in Japanese money velocity. A very clear relationship since the early 80s. That is telling us there is probably something to this. And if you look at the US and we look at Europe, we've seen the similar tendencies since the beginning of 2000s, the end of the 90s. The working age populations as share of GDP has steadily started to decline, particularly in the US. And as that is happening, money velocity has been declining as well. So of course this is coinciding with the Great Recession, but it's notable that this is unfolding. And therefore, even had there not been a Great Recession, we would have seen a situation where US money demand likely would have gone up and money velocity would have gone down. And then it itself would have necessitated some kind of quantitative easing, or at least a significant lowering of interest rates relative to what they were, for example, in the mid-90s. So we have a phenomenon which is structural here. It's a demographic phenomenon and it's clearly impacting money demand. This is telling us something. If money demand is going up and money velocity is going down, that for a given money stock is deflationary. So while we could have a situation where negative or aging of population lowers the real interest rates and causes a tightening of monetary conditions if the interest rate is kept stable, we have the same phenomenon in terms of money demand. If money demand is going up, money velocity is going down, then for a given money stock, that will also be deflationary. So we have these two channels by which an aging population could be deflationary through monetary policy. So what is needed is, of course, in the case of interest rates, if you hit the zero lower bound, the central bank needs to print money to compensate for that. At the same time, if we are at the zero lower bound and the aging of the population causes an increase in money demand, the central bank has to print money to meet that increased demand for money. So both of these factors necessitate what we call quantitative easing. This is nothing to do with the business cycle, it's just to do with the fact that structural factors is pushing down the natural interest rates and is increasing money demand. The central bank's obligation, therefore, if it wants to keep hitting its inflation target or whatever nominal target it has, it needs to offset these structural factors by increasing the money base. This is also telling us something about what is going on going forward. The tendency we have seen in recent years is likely to continue going forward. Therefore, if the decline in money demand or in money velocity in the US to a very large extent have been driven by demographics, which I think is the case, then this is not a temporary phenomenon due to the Great Recession. Some of it clearly is, and some of it has to do with regulation, but I think demographics plays a key role here as well. Then when the Fed is talking about normalizing its balance sheet, it's basically the wrong policy, because it's normalizing. When talking about normalizing, it's essentially talking about having a money base which is equal to the situation when the baby boomers were in the labor market. However, when the baby boomers are leaving the labor market, money demand goes up. And the central bank, the Federal Reserve, has to offset these factors by increasing the money base. Therefore, I think that any talk about normalization of the money base or the balance sheet of the Federal Reserve need to take into account these demographics factors. If they don't, the Fed will end up, as Bank of Japan did for decades, undershooting its inflation target. I hope the Fed has learned something from the experience in Japan. At the moment, it doesn't look like that, but sooner or later, I think the fact that the Fed will continue to undershoot its inflation target will have to convince the Fed that more deep and structural factors are in play, and that you cannot normalize, quote unquote, the balance sheet. The balance sheet needs to be larger, probably significantly larger today than 10 or 15 years ago, even if we disregard the effects of the Great Recession and regulation. Just demographics on its own necessitate this. I think I'll return to this topic going forward. I hope to write more about it, but clearly I think demographics is something to watch. Demographics is not deflationary on its own. Demographics is only deflationary when central banks make mistakes. But demographics could make these mistakes more likely. I'll get back to you soon. Take care.